Debt financing and equity financing are two primary methods that businesses use to raise capital, each with its advantages and considerations. Let's compare these two financing options. Debt financing. Nature. Debt financing involves borrowing money from lenders, which can include banks, financial institutions, or individual investors. Ownership. Debt financing does not dilute ownership. Business owners maintain full control over the company. Interest. Borrowed funds come with an agreed-upon interest rate that the business must pay back to the lenders. Repayment. Debt financing involves fixed repayment terms, including regular payments of principal and interest over a specified period. Risk. The business is obligated to repay the debt regardless of its profitability. If the business struggles, it still must meet its debt obligations. Equity financing. Nature. Equity financing involves selling ownership shares, equity, of the business to investors. This includes venture capitalists, angel investors, or the public through an initial public offering, IPO. Ownership. Equity financing dilutes ownership as new shareholders become part owners of the company. Returns. Investors who hold equity shares may benefit from the company's success through dividends or capital appreciation if the business performs well. Repayment. Unlike debt financing, equity financing does not require regular repayments of principal or interest. Risk. Equity investors take on more risk than lenders because they share in the business's profits and losses. If the business fails, they may lose their investment. Considerations. Cost. Debt financing may have lower overall costs if the interest rate is lower than the return expected by equity investors. Equity financing may involve giving up a larger share of the business's future profits. Risk tolerance. Debt financing can be attractive for businesses with stable cash flows and a lower appetite for risk. Equity financing might be more suitable for high-growth startups that lack consistent cash flows. Control. Debt financing allows the business to retain control, while equity financing involves sharing decision-making with new shareholders. Flexibility. Debt financing requires fixed repayments, which can strain cash flow. Equity financing does not involve fixed payments, giving the business more flexibility. Ultimately, the choice between debt and equity financing depends on the business's specific needs, risk tolerance, growth plans, and financial situation. Many businesses use a combination of both methods to achieve their funding goals while managing risk. FAQ section. What is debt financing? Debt financing involves borrowing money from lenders, such as banks or investors, that the business agrees to repay with interest over a specified period. What is equity financing? Equity financing involves selling ownership shares, equity, of the business to investors, giving them a stake in the company's success. How does debt financing impact ownership? Debt financing doesn't dilute ownership. Business owners maintain full ownership. Lenders only have a claim on the borrowed amount. How does equity financing impact ownership? Equity financing dilutes ownership as new investors become partial owners of the company. Business owners share ownership with these investors. What are the repayment terms for debt financing? Debt financing requires regular fixed payments of principal and interest over an agreed-upon period, regardless of the business's profitability. What are the repayment terms for equity financing? Equity financing doesn't involve regular repayments. Investors benefit from the company's success through dividends or capital appreciation. Which option has more risk for the business? Debt financing comes with an obligation to repay regardless of profitability, making it a higher risk option if the business faces financial challenges. What about risk for investors? Equity financing involves more risk for investors since they share in the business's profits and losses. If the business fails, they may lose their investment. Which method is suitable for stable cash flow businesses? Debt financing is attractive for businesses with stable cash flows as they can handle regular fixed payments of principal and interest. Which method is suitable for startups or high-growth companies? Equity financing is often more suitable for startups that lack consistent cash flows but have high growth potential. It allows them to bring in investors without immediate repayment obligations. Can a business use both methods? Yes, many businesses use a combination of debt and equity financing to balance funding needs while managing risk. How does cost compare between the two methods? Debt financing may have lower costs, interest rates, than the returns expected by equity investors. However, equity financing might involve giving up a larger share of the business's future profits.